और ये जो
Okay.
बहुत मतलब फाइनेंस में जो फॉर्मूलाज हैं और ये सब हैं, ये किस तरह से आप इसको इक्वेशन छोड़ के, जैसे इक्वेशन डिफिकल्ट हो जाता है करना, और वो पर्पस भी नहीं है हम लोगों के इस क्लास का। लेकिन एक अगर इजी वे में हम इसी चीज को एक्सेल में कर सकते हैं तो वो जानने में कोई खराबी है नहीं, और आप लोग को आसान होगा। और मेरा मानना है कि ये आपको हेल्प होगा नॉट ओनली इन द फॉर फाइनेंस इन पर्टिकुलर, बट ऑल्सो इन योर पर्सनल, for your personal financial planning, there also you will find that this is going to help. इसलिए आज हम लोग जो करेंगे, I'll take you through step by step. और हम लोग जैसे कल एनपीवी कैलकुलेशंस हम लोग कर रहे थे, अब वो हो सकता है कि समझने में दिक्कत हो रही हो, लेकिन अगर आप इस चीज को एक्सेल में करेंगे खुद, तो आपको लगेगा कि नहीं ये काफी इजी है, कॉन्सेप्ट भी समझ में आ जाएगी आप लोगों को, एंड इट विल बी गुड दैट वे। ठीक है ना?
Okay, okay, fine, sir.
How many of you
Good
are here?
evening, sir.
Good evening, Shruti. Good evening, Anamika. Should we wait a little? Can you give me some feedback about yesterday's class? Yesterday, for the first time, I introduced a little more numbers into your into the class. Today, we will continue with some numbers, but today I'll show you in Excel also, so that you'll feel a little easier to understand what we are doing. So we'll go back to NPV today and we'll see how to proceed from there. Aaron is here. Adhi Richa is here. So 9 of you have joined so far, and Meghna is here. Very good. 10 people already. That's nice. See, one thing which I'd like to stress, and today when we do some Excel exercises, you'll see why I say this. See, finance has become simplified because a lot of the hard calculations which are there in finance can now be done in Excel. All that is required is that you understand which formulas to use and what is the meaning of the terms used in the formulas. If you can understand that, then it is very easy. Today, what we will do is, if all of you have your laptops with you, if you open to a blank Excel sheet, I will show you how you can do it step by step and arrive at the same results which I have been showing here. So in that way, what will happen is that some concepts which are at times a little difficult to understand when it is stated as a principle or when it is, told to you theoretically, it will become much, much easier to do this if you do it yourself in Excel. So I'm just hoping that today in the class, you people will join with Excel and then we can do it. Because finance today, now, suppose you join a company as a finance manager. What will happen is that the company will have some particular software which it uses. And that software will be very easy to navigate. They will tell you that, look, this is a software. They'll give you a short training. You can go and you can use that software to do different things. And normally to present a report of what you have done or to show some idea that you have something about numbers and all, you can use Excel. So knowing Excel is something which is, if you propose to stay in finance, you should know a lot of Excel. If you propose to just, let's say, be an entrepreneur tomorrow, then also you should know Excel, but maybe not in depth. But it will always help you. And frankly speaking, even for your personal financial planning, when you begin to earn money and when you want to do this, even personal financial planning, you'll find that Excel is very, very good that way. You can, actually understand. And today I'll show you different ways of, how you can actually do it. So there are 12 of you are here. I think we can start now. So I'll share the screen. Okay. This, particular thing which we did yesterday, this is again something which I think you people will at some point of time begin to appreciate. This one, even if you don't, immediately understand the utility. But if tomorrow you actually decide to, even consider going for a venture, this particular part is going to be helpful for you. So we did all this. Okay. And we did break-even point, and then we were doing time value of money. Okay. We did compound interest. So we looked at future value, very simple interpretation here. You understood this, that when we have to the power 3, basically it means doing this. And you understood the concept of number of periods, where we said that if compounding is happening once a year, then the number of periods in the year is 1. But if compounding is happening 4 times in a year, quarterly, then the number of periods within the year are 4. This is going to be useful as we go ahead. Now we come to this place, this net present value. Now in the net present value, basically what we were saying is that before you make an investment, it is good to know whether you are actually that investment is going to be profitable for you. And it is going to be profitable for you only if the investment is able to give you a return which is better than the return you could have got by putting that money somewhere else. And when we say this, that we have invested 10 lakhs, and this 10 lakhs is going to be invested, and I'm going to get these, this 3 lakhs per year for 5 years. And then I say that let us discount this by 10%. So we are dividing each by 10% becomes 0.110. We add 1 to it, 1.10. So we are discounting it by 1.10 in the first year, by 1.1 squared in the second, 1.1 to the power 3, then to the power 4, etc. Now, this 10% which I am using, what I am trying to say is that if I invest here, if I make this investment, and if this particular estimate is correct, that I am going to get 3 lakhs every year for 5 years, then at the end of the day, I will end up with more than what I would have earned had I invested at 10% in some other company, or in some other way of investing the money. So as you can see out here, I invested 10, I got back 1137 in terms of present value. So this means that my net present value is positive. If it is positive, if this figure is positive, then basically this means that I can make the investment. Now, this is one of those things which every industrialist, everybody who's interested in actually trying to invest and make money, all of them are very interested in understanding this particular thing, this NPV concept. Okay, am I going to actually, at the end of the day, have I made money? Or could I have made more money by simply going some other route? And that is why, putting a rupee value to my entire investment, and in terms of present value. Remember, the other part of this is that we are looking at present value. What is the value of each of these cash inflows today? So basically, I'm reducing everything, each and every inflow, to today's value. I'm adding it all up. I get this figure. See, you note that you actually got 15 lakhs, 333, you got 15 lakhs. But when you use this discounting principle, you ended up with 1137 and you had put in 10. But what you have done is this 1137 that you received is the value of all these these cash inflows today. That is the main thing. And so I end up with this minus 10. I get a positive figure here. There's no minus sign. I'm getting a positive figure. Therefore, this tells me that I can actually go for this particular investment. It's good. I should buy that machine. I should try to do this. It's okay. Now, let's take the same thing over a 10-year period. So when we took it over a 10-year period, we found that the total comes to less than 10. It comes to 921. Why did this happen? See, it's even here it is 15 lakhs. But the present value here is 921. But the present value in the last case was 1137. Why do you think this happened?
So because over the period of time, the value of money decreases because of inflation and or
no, not inflation.
The rate of discount increase.
Exactly. The rate of discount, you notice, see, here you divide it by 1.10. Here you divide it by 1.21. Here you divide it by 1.331, 1.46, 1.61. See, the discount rate is increasing. And why is it increasing? Because money which you receive at a later point of time in the future, that money is going to have less value. See, all of you agree that if I receive 1,50,000 1 year from today, it is going to have less value than 1,50,000 today. That I think all of you agree with this. This whole time value of money thing, when we began this discussion, all of you said that yes, money which I have in hand is much, much more in terms of value than money which I will get in the future. Then by the same logic, the money which you received 2 years should have less value than the money which you received 1 year later. And the money which you received 3 years should again have less value than the second year. Though it is in actual terms, it is the same. But in terms of present value, you see this keeps decreasing. So look at the 15th year. This 1,50,000 has come down by almost 1 lakh. It has come down to 57,000. 93,000 has gone. Because that is the price which you are paying for receiving it late. And this is why when I add all these together, I am getting 921, whereas in the previous example where 333 lakhs were received for 5 years, I was getting more than 11 lakhs. And because of which my net present value was positive. Remember, I was telling you that the word net in finance, it means to minus something. So why am I saying net? Because the sum total of the present value is this. From this, I am deducting the original investment of 10 lakhs. And I am ending up with a negative figure here. If I am getting a negative figure, this means that this is not a good investment for me. I should not go this route at all. So we said the NPV is negative, the investment should not be made. Then it is better to do something else. If you have a different approach, do that. You can think about this in a different way also. Right now, we are comparing this with different investments. Like instead of buying this machine, let's say that I had the opportunity to invest in a different company. And in that company, I would have earned 10%. If I go here, it is going to minus, therefore I'm earning less than 10%. But there is another way you can think about it. Suppose this 10 lakhs which you invested, this 10 lakhs was money which you borrowed at 10%. Suppose you had borrowed this money from a bank at 10%. And then you use this to buy the machine. The machine gave you these cash flows over 10 years. And at the end of the day, you ended up with this. This means you will be paying the bank interest at 10% and you're getting less. So at the end of the day, you will have an actual loss. After so many years and so much hard work, you have earned nothing. The bank has eaten up practically all your money. And it has also dipped into your pocket to the extent of 78,000. That is why this figure has to be positive. This is the important thing here. So when I get this, this means that the rate of return from this investment is less than 10%. Okay. Now, can we imagine a situation where the amount I get here and this 10 lakhs, and this is also exactly 10 lakhs. Theoretically, it should be possible. It should be possible for me to have cash flows for 10 years, the total of which will be 10 lakhs. If that is the case, then what will NPV be? It will be 0. Okay. Now, that particular interest rate, which I use for discounting, which will make this NPV 0, is known as the internal rate of return. Let's try to understand this here in the next slide. Internal rate of return. So what is the rate of return that this particular project is actually giving me? This project is what? I have given 10 lakhs. So I have written this again. So I am saying, suppose you want to invest in a project. The cost of investment is 10 lakhs. You can borrow the funds from a bank. Now, the life of the project is 10 years. That is, for the next 10 years, it will give you a return every year. You need to know the rate of return that will make the present value of the cash flows exactly equal to the amount that you had invested. You had invested 10 lakhs. Now, all the cash flows that you got for 10 years, I get the present value of each. And if the sum total of that also comes to 10 lakhs, I have found my internal rate of return. See, if you know this, then you can decide whether to invest in the project or not. Now you have an estimate of the cash inflows of the project will generate every year for a period of 10 years. You use a simple IRR formula in Excel and you find that the rate of return of the project is 8.144%. Now let's look at this. Suppose I discount by exactly this. How do I know that this is the rate which will make this zero? Because I have used Excel, and that I'll show you. But for the moment, just look at this. What I have done here is I have discounted each of the cash flows by 1.08, then 1.08 squared, then to the power 3, to the power 4, etc., till we reach here where it is to the power 10. And when I added all this up, I got exactly 10 lakhs. Now this means that this particular this project that I have, it will give me a break even. Break even is not a right word. I will get my investment back in 10 years because this is the rate, 8.144 at this year. This means that if I invest in this and it has an IRR of 8.144, this basically means that I should not invest because then I'm not making any money. It also tells me that if I can find some other investment, if I can find some other way of investing my money where the internal rate of return is more than this, in fact, it is more than my cost of capital, then I can safely invest the money. Are you getting my point? The whole purpose of investing is to make a profit. Now, if I know at which point I'm getting my investment back, then I can understand that if I can find a different project where the IRR is higher, then it will be possible for me to actually.
So means that NPV after 10 years will decide that we should continue the project or not?
No, not continue. Where right now, Tanya, you are making a paper calculation.
Yes, sir.
Right now, you have not actually made the investment. You have decided, you have this idea in your mind that I can invest 10 lakhs, and you talk to experts and they tell you if you buy this machine and you use this, your sales are going to go up by 150 per year. And not sales, your after-tax profit will go up by 150 per year. You will make 150 more in profit every year. Now, you have to find out that whether this particular rate, if I get 150 of profit each year, is it worth investing 10? Because when I am investing, I am taking a loan from a bank. And let us, for the sake of argument, say that the bank is actually charging me more. It is charging me, let's say 10%. Then that tells me that if my rate of internal IRR is 8.144 and the bank is going to charge me 10, then there's no point, I lose money.
Yes,
so there are only two options which are there. Either I should abandon this project, find another project. This is one. The second is I find some bank which is willing to give me the money at a rate which is lower than this rate. Suppose a bank comes and they say, I can give you the loan at 7%. Then you will make a profit. No? You will get, and the bank, because the bank is giving you at a lower rate, so you will make a profit in that case. Then it's okay. So if I were to...
So that means that whenever we are going to start any kind of project, if we make a rough scale in our mind, that rough sketch that we have to invest this much and particular year we are going to have this much profit. So always we will search for a bank that will give our investment. मतलब बहुत कम पैसे में वो लोन को चार्ज करें.
हाँ, लेकिन ये जानना जरूरी है ना कि कितने, मतलब मिनिमम कितना चाहिए.
Yes, sir.
So this gives you that figure. IRR, internal rate of return hai. This project is going to give you back your investment in 10 years at this rate. This is what this is saying. This means if I have to find a project which is higher than this, or alternatively, I should find a means of financing which is lower than this. If suppose I am unable to find, कोई ऐसी बैंक नहीं मिलती मुझे जो कि मुझे 8.144 से कम में दे दे, then what can I do? The only option that I have in that case is that I will have to basically go for abandoning this project and look for something else. Now, suppose I want to do this in Excel. So what I suggest is all of you just open your the Excel that you have on your computer, and just a minute, let me see if I have done this here. I have not actually put my stuff on Excel here. Okay. Okay, you can do one thing. What you do is, okay, open Excel, I'll guide you through it. Open Excel. Instead of typing in 2 rows, you type in 1 row. Year 1 to year 10. Just write 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 in each of the columns. You got that? 1 to 10, all of you?
Yes.
Okay. Now, in the row just below year, this 10 lakhs, you write minus 10 lakhs. Minus and 1 with 6 zeros. Okay? Now, in the third row, this row, where I am writing 138, in this row, 1 row below 10 lakhs, in each of the columns, just write 150. 150,000, 150,000 in each of the columns for the 10 columns that you have.
Sir, can you repeat, please?
Yes. In the first, have you done this part here? Years 1 to 10, you need 10 columns.
Yes, sir.
That you have done. Okay. Now, before the year 1 starts, you write minus 10 lakhs. And 1 row below that, you write 1 lakh 50, 1 lakh. This 1 lakh 50, which I have done, put it 1 row below. You have this, all of you?
Yes, sir.
Okay. Now what you do is, in a separate, let's say over here, in a different cell, just select one cell, write equal to, press equal to, write in capital IRR. Open a bracket. What have you got? Equal to IRR, open brackets. One bracket open. What is Excel saying now? It is asking you to put a range. Correct? Select the range from 10 lakh up till the last cash flow. All of the 10 columns. From 10 lakhs right up till the end. And remember, this should be in 1 row below. Have you selected?
So please repeat once again.
From which point? The formula.
Yes, sir. After that.
So you have all of you put the numbers there, 10 lakhs and 1,50,000. That is there for all 10 years. No?
Yes, sir.
And the 150
Yes.
is one row below the 10 lakhs. Okay, and 10 lakhs should be minus 10 lakhs. Just put a minus sign out here. Now, in a separate cell, let's say you use this cell. In this cell, you type equal to IRR open bracket. Now, you select this entire range. You start from 10 and go right up till the 10th year. 10 lakhs, you start at that point and select the range right up till the 10th year. Once the selection is there, just press enter. Anybody did it so far?
So it's giving 8%.
8%.
8%. Exactly. What do we have out here? It is 1.08. This is also 8%. What happens is, if I suppose use only 8%, I will get a small fraction here, 6,000, 7,000, something like that will come. But what this tells me is, have all of you got 8%? Then you have just calculated the IRR. Then all of you have already learned how to calculate the internal rate of return. See, basically what this is telling you is that you should be getting more, you should either get your cost should be less than 8%, or you should abandon this project and go for a project which has a return of more than, much more than 8, somewhere around 11 or 12%. Because your cost is coming to 10%. You will be borrowing money at 10%. So do you understand this now? All of you. This concept is a very basic concept in finance. Net present value and internal rate of return. So net present value you already know. Now, using those same figures, if you actually do it manually, suppose you now try to do it manually. So you have these figures, right? Now, one row below that, you type this 1.08. Just put 1.08. Just in the year one column, below 150, type 1.08. In the year two column, you type 1.08. You see the 6 in your year, where the numbers are there on the top. Just above 6, you will have an inverted V. Can you see that?
Sir, do we have to write just below or leave one column?
No, you write just below. Here it doesn't matter. You write just below. You write in the first column, you write 1.08. In the second column, okay, do one thing. You write this figure only. Write this 1.16, 1.26, 1.36, 1.47, 1.73, 1.87, 2.02, and 2.19. Have you got that? Just confirm once you have done that. Just check, I'm calling again. First year 1.08, second year 1.16, third year 1.26, fourth year 1.37, fifth year 1.47, sixth year 1.59, seventh year 1.73, eighth year 1.87, ninth year 2.02, and 10th year 2.19. All of you have put these figures. Now go one row below. Come back to year 1. Go one row below and you type this formula equal to, right, equal to, select 150 divided by 1.08. Just select that next and say enter. You should be getting this figure, 138,704.
Sir, can you repeat once again? Select 150.
Select 150, use the divide sign, slash, and then select this 1.08144 and type enter. Got it? No?
No, sir.
Then you are making a mistake. Has anybody got it?
Yes, sir.
Uh,
1,38,888.9.
Okay. So, anybody else?
Yes, sir, I've got the same amount.
Yes, sir.
Paresh ji, you got it?
Yes, sir. Yes.
See, what you do is, if you cannot do it like that, use the cell address in that case. What is the cell address for this? It will be A something or B, whatever it is, B something like that. It will be here. Some row number will be there. Some column number will be there. You can use that and divide by, again, find the cell address for this and divide. What you do is, if you do this for each of these 10, you can do this later. If you do this for each of these 10, but just remember that I've already given you the actual discounting values for each of the 10 years. At the end of it, you will come to a figure now, which is just a little higher than 10 lakhs. So this will tell you, see, suppose the figure comes to 7 or 8,000. You don't want to do a 10-year project to earn 7,000 rupees now. So basically, this is the rate, which is the internal rate of return. Okay, let's stop here for this and go to the next part now. Okay. Now, the next thing which I really want to speak about is, this is another very basic thing in finance. Risk and return. So normally what happens is, if you make an investment of rupees 10,000 in the bonds issued by a company, a bond is like a fixed deposit. As per the terms of the bond, the company has committed to give you 10% return per annum. Let's say that in a bond, what happens is that you will get a certain return, like interest. You will get a interest. Company will pay you 10% every year, and they are offering you 10%. Okay. Now, is this taking into account the time value of money? time value is being taken care of? Because they are giving you 10%. So if you invest 1,000 rupees today, after 1 year, they will give you 1,100 rupees. So they are giving you something more than what you invested. So I think we can safely say that yes, it has taken care of the time value of money. Now, is it risk-free? This I want you people to answer. When you invest in this company, is it risk-free?
No, sir, because if the company goes into loss, then the investment will be not profitable for me.
You see, simply not into loss, but let's say that the company fails, then I have lost my investment. Okay, so it is not risk-free. Now, what is a risk-free return? So this is a return that is offered to you without risk. This is the meaning, na? Who can offer you a return without risk? And what should the rate of return be, higher or lower? So the risk-free rate of return means that there is no risk. The first question is, who can offer you this? Only
The
one
banks?
entity. No, not even banks. See, we know of banks which have failed. We know of banks which have failed. So we should not say banks will offer you a risk-free rate. It'll be a lower risk, definitely, but not risk-free. Who offers you risk-free? Only one entity is there which offers you risk-free. Think.
Government?
Yes, it has to be government, na? Because government is always risk-free, because if they get into trouble, they can always print the money and give it to you. What will the government do? Suppose they don't have money, they can simply go to the mint, print money, and they'll give you that money. You'll get back your money. So that is, I'm saying that in a light way, but generally governments are very responsible. Any government in any country will be a risk-free investment. Okay. Now, since it is risk-free, the rate is also going to be very low. So the lower the risk, the lower the rate also. Now, rate offered by the government. When you invest with an entity other than the government, you take a risk. We just saw that when we invested in a company, there is a risk. And when you take a risk, you are entitled to a higher return. That is the basic concept in finance, that if I take a risk, you have to give me something which is more than the risk-free rate. So if the government is offering 4%, and you also offer me 4%, why should I invest with you? Because there is a risk with you, there is no risk with the government. So to protect myself, I'll never give you, I'll never go to you and invest. Now, how does the company attract me? Okay, there is a risk. But despite the risk, you still come and invest with me. How will it? What incentive will it give you? It will have to offer you something more. So it will say, if you invest with the government, you'll only get 4. Okay, there is a risk, but we are a good company. You look at us, we have been there for the last 20 years. We are doing okay. And we have never actually gone back on any of our commitments. So we will give you 10%. We'll give you 10%. This difference between 10 and 4, this is known as a risk premium. Just know the word. All I am interested here is you should know the concept of risk-free return and the concept of a risk-free rate and risk premium. So what this basically means is that suppose tomorrow you'll check out the bonds which are being offered by private companies in the Indian stock market. And suppose you come across a bond which is offering you, let's say, a very high rate, 11 or 12%. one thing which should straight away come in your mind is that why is this company offering me a higher rate? It means they are trying to somehow, they are trying to give me an incentive. Come and invest with me. If I am greedy, I will go there. And maybe I will not consider that there is a huge risk. To help us, sometimes what the government insists is whenever a company comes out with a bond, they should get the bond rated. Somebody will come and say, is this a good bond, or is this a medium class bond, or is this a bad bond? A good bond is when a company is in a position to give you interest at the designated interval every year or every 6 months, and which at the end of the bond maturity period is in a position to return the money to you. This is what you will call a good company. So normally the rating will be AAA or AA. Now there can be other companies which are not that good. So there maybe the rating is only single A or maybe even BB. And maybe there is a company which is even less, let's say, good. So there maybe the rating is only C. Now, which of these AAA to C, which is going to offer the lowest rate of interest?
Double.
AAA. Double A will also give you a low rate, I'm sure. But the lowest rate is going to be offered by AAA. So it doesn't matter. So in that case, if they are offering you a lowest rate because the risk is the lowest, then C will be offering you the highest rate. And let's say that tomorrow you look at the actual, at maybe Money Control, and you find that, yes, there is a company which is offering me 12%. So one thing should straight away come in your mind, that this is going to be a risky investment. So the whole point in this is not to understand that particular point. That is that investment. Has everyone followed this part?
Yes, sir.
Everyone?
Yes, sir.
Yes.
Okay.
Yes, sir.
Then let's go to the next part here. So the higher the risk, the higher the return. So C, risk is highest, they will give you the highest return. Now, let's go to another concept. You have heard of the word annuity, I think. It's a very simple thing. An annuity is a fixed payment or receipt each year for a specified number of years. Annuity is coming from the word annum. Annum basically is 1 year. So if a particular amount of money is coming to you every year, we call that an annuity. Similarly, if you are paying someone a fixed amount of money for a number of years, then for that person, that is an annuity for the person to whom you are paying. Now, let's say that you deposit 1 lakh with an investment company and they promise to pay you 10,000 every year for 10 years. Then this 10,000 is an annuity. Okay. Everyone clear about this? Very small point, but it will help in our next thing. Now, another example. You want to take a flat on rent, you find a landlord. He says, okay, you pay me 1 lakh per year as rent. This is also an annuity. You are paying a fixed amount of money and maybe for 4 years you are paying this. Now, the question is, suppose the landlord, okay, the first 1 lakh, from the landlord's point of view, how much money will he get at the end of the 4th year? Or let's say after 4 years, how much money is he going to get there? He is getting 1 lakh per year and he is putting it in a bank. Let's say he is not taking the money out. Now, basically what happens is, if I know the rate of interest of the bank, it should be possible for me to calculate this and find out how much the landlord is actually going to get. Now, let's say the bank is paying 6% interest. Okay. Now, the first year you pay 1 lakh, and the condition is that you are going to pay it at the end of the year. Okay. You will pay it in December. Let's say you came in January, you will pay in December. You pay 1 lakh. This 1 lakh will remain in the bank for 3 years. 1 year is already gone. Now you're paying 1 year late. So it will stay for 3 years. Now, if it stays for 3 years, that means it will grow to this amount, 1,19,000. How am I getting this? I am first taking this 1.066 here and taking it to the power 3. I'm cubing it, taking it to the power 3. And then I'm using that. I'm getting 1.19102. I'm multiplying that by 1 lakh and I'm getting this. So the first money which I gave the bank, or gave the landlord, he put it in the bank. After 4 years, he gets this. We are calculating only for 3 years because he's getting the money at the end of the first year. Only 3 years are left. Now, in this case, the second deposit which you give at the end of the second year, that is staying only for 2 years. So in this particular case, how much will that money earn? It will be 1.06 squared. That means 1.123. You multiply that by 1 lakh, you will get this. Correct? And then in the third year, you pay 1 lakh. This stays only for 1 year. So basically, you will get 1,06,000. And the fourth one is immediately, that is the last one. It is not staying at all. So you will earn nothing on this. Now, if you add all this up, what are you going to get? You will get roughly 4,37,000. Now, the point is that this is not a very convenient way of doing it. Like if suppose you actually want to make a calculation, let's say you are the landlord and you want to find out, then it is not reasonable that you are going to sit down and do all this. This is okay for a finance teacher to do this. But I don't think somebody who is actually in the business of renting a place will want to take all this pain. So why don't we do it in Excel? Once again, what we can do is we can try to do this in Excel. Now in Excel, once again, I'll ask you people to open a clean sheet and I'll show you how you can do this. So what you do is you create this. In column A, row 1, you write PV. You don't have to write the full thing. You can see what the present value. Row 2, you write annuity or just write payment. In row 3, write rate. In row 4, write years. And in row 5, write FV, future value. Do this first. Everyone done it? Now, here in C, you can do in B also, it doesn't matter. I have just done this so that there is more space. Here you write 0. Here you write minus 1 lakh. Remember, he is getting 1 lakh per year. Then you write 0.06. This is the rate of interest. 4 years. N per means number of periods. And PMT means payment. Rate means interest rate. FV is future value. Here we are going to put a formula. Don't write this figure. In this place, we will put a formula. Has everyone done this? All of you?
Just a minute, sir.
Peron, you've done it?
Yes, sir.
Okay. Everyone done? Okay. Now you go to this cell. Number 5, C5. Come here. Type this formula. Equals FV bracket open. In place of rate, you click this. Just take your cursor and click this place. Then put a comma. Then in place of N per, you click this place. 4. Put a comma. Then you put a minus sign and click this. Oh no, there's already a minus sign. Sorry. Just click this for payment. Put a comma. Then click this C1, the 0 here. And then put a comma and put one more 0. Okay. Now enter. If you have done it correctly, you will get this figure.
Yes, sir, got the figure.
Got it? Shruti?
Yes, sir.
Okay. Tanya? Aaron?
Sir, I'm doing.
Okay.
Yes, sir, got
So, see, this is a simple way of calculating the future value. So, if you know, if you have any payment that you are going to receive on a fixed basis, and if you are in a position to put that in a bank, and the rate of interest, whatever is the rate of interest, if you use that, put the number here, put the actual figure here, just use a minus sign, use this formula, you will get it without any problem. And
So why
this, yes, why?
So why did we use this 1 lakh as minus 1 lakh?
I don't know. I cannot answer that question. This is, the formula which they have done in Excel. Why they do it like this is beyond me. I have tried to think about that myself also. In the net PV and PV calculations and all, it makes sense to putting a minus. But here, I don't know why they are using a minus sign. So let's not worry about that. See, this is the best part now. You rely on Excel to do the right thing. Even when we calculated this manually, we got this figure only. Remember, in the last slide, we had done this manually and we got this. So this is a very good way of actually calculating this. Okay. What have we calculated? We have calculated the future value of an annuity. Okay. This is what calculation we have done. Now I'll show you another one which will be more useful. Now there is a concept of a sinking fund. So sinking fund is a fund that is created out of fixed payments each period to accumulate to a future sum after a specified period. This is a standard definition, which you will not understand, I'm sure. It doesn't matter. You think of it like this. Think of this as a monetary goal. Suppose you want to have 3 lakhs after 3 years to buy a car. Let's say that this thing is in your mind, that I need 3 lakhs. I can't buy a car today. I don't want to take a loan. I want to buy the car with my own money. So for 3 years, let me save some money and I'll get my car. But I want to save exactly 3 lakhs. The bank is giving me interest of 6.5%. So what amount should I deposit in the bank so that I get exactly 3 lakhs after 3 years? And let's say that we are depositing this money once a year. Every year, I'm going to deposit this only once. Is everyone clear about this?
Yes, sir.
Now, to do that, I can use once again a very simple Excel formula here. So you type all this, ABC. PV, FV. This 3 lakhs, once again, put a minus sign. Rate, N per, amount, sorry, not amount, PMT. Where the PMT, after that, when you come here, you have to put this formula.
So what's written after minus F?
FV, comma, 0. Close the bracket and enter. Or even just write enter. You should get it. Got it?
Yes, sir.
This Excel file which you have used, save this file. So that in future, whenever you want to do a calculation which is similar, and this particular calculation of sort of saving for a goal.
Excuse me, sir.
Yes, Tanya.
Sir, after minus F, what is written?
Minus FV, just select this.
Okay, sir.
Put minus and select 3 lakhs. Then put a comma, put a 0. Got it, Tanya?
No, sir, I'm not getting.
You're supposed to put a 0 after minus FV.
FV, comma, 0.
Okay, sir, okay.
How many people have finished this?
I did.
Sir, completed.
You finished? Okay.
Completed.
Peron?
Yes, sir. Completed.
Completed? Good. Now, this, what you notice here is, I needed 3 lakhs in 3 years. The bank was giving me 6% interest. I have to basically deposit 94,232 rupees, or let's say 33 rupees every year. If I do this, at the end of 3 years, I'm going to end up with 3 lakh rupees. Now, my point is, this can be used by companies also. This can be used by each one of us as a personal goal also. Suppose, you need some planning. As for your personal financial planning purposes, you should have some goals. Only then will you save money. And this is a very good way of understanding how much you should save. So you can adjust these in the Excel sheet and you will get your correct figure. Now, this concept of, this money that you are actually doing in a company, this is called a sinking fund. This particular thing here, this 3 lakhs which I want to create, this is called a sinking fund. It can be for any purpose. See, a company may want to do this for the purpose of replacing an asset. Remember when we were charging depreciation? Suppose the amount which you charge as depreciation, you invest that amount. You're already debiting your expenses. You take an equivalent amount of money and you put it in a bank. You know exactly how long it will take for you to get back the value of your asset. And then when that period is over, you can use that money to replace the asset. So this is, in the case of companies, this thing is known as a sinking fund. In the case of individuals like you and me, you can call it a monetary goal. It's a financial goal for you. Now you take the case of a company which has issued bonds. This company can create a sinking fund to repay the bonds. Remember, companies take huge amounts of money from the public and they ask them to buy bonds from their own bonds. And these bonds may have a maturity of, let's say, 5 years, 10 years, something like that. And when the bond matures, that entire amount of money has to be paid, 100 crores. So if the company, is not planning for this in advance, what will happen is that it will not be able to pay back that money. And that is why it is necessary for the company to do something like this, create, it is just like your monetary goal. So has everyone done this?
Yes, sir.
All done? Okay.
So,
Yes.
so why can't we say that reserves and sinking fund are the same thing? Because in reserves also we take out some portion of money and then keep it for the later purpose.
No, it's that is not the point. You can purchase an asset from your reserves. I am not saying that. But the basic point is that in the case of a sinking fund, suppose you adopt this method. See, a reserve is something which is again plowed back into the company. The reserve is not lying idle, remember. When in a company, when we say reserves, that reserve is not something which is lying idle. That is a liability. It's a source of fund. What is the reserve? The profit that I earned last year. If I did not distribute that profit it goes back to the owner. Now the owner does not show it as his own capital. He creates a separate head for it. He calls it reserve and he puts it there. The reserve is basically the undistributed profit of each year. So every year the company, let's say, gives dividends. Let's say the company earns 100. 50 rupees is given as dividend, 50 rupees is left. That 50 rupees I put in reserve. Now this 50 which I put in reserve is not actually like a reserve. It's not just kept in a bank account. That 50 is again used. That 50 is used for the day-to-day running of the business or for buying an asset or for some particular purpose. So you should not compare sinking fund with a reserve. A sinking fund is actually a planned way of accumulating a certain amount of money for a specific task. So you are actually trying to create this money. Let's say in this example, I want to repay a bond. In 5 years' time, I'll have to pay this 10 crores. And it will be difficult for me to suddenly repay that entire amount of 10 crores. So what I do is I create this sinking fund. I gradually accumulate it. And the sinking fund will only come when I invest it somewhere. So I put it in a bank or I put it somewhere else. And I have this rate of return in mind. Okay, I'm going to earn this much every year. And then when I have that, I know exactly how much I need to save each year, how much I need to put aside each year. And at the end of the day, I'll have this sinking fund and I'll be able to use it for whatever particular purpose that I had in mind. Okay. Now, after this, we come to this next point, which we can again discuss this. So now I'm getting into something which is absolutely non-numerical. This is not numerical at all. And this will be something which I hope it probably will be one of the easiest parts of this discussion that we have had over 4 sessions. So I thought, let me keep the easy thing for the last. So companies raise capital by issuing different financial instruments, correct? So examples are equity shares, preference shares, bonds, debentures. Now, since this is an area about which you may have had some previous knowledge, without any cheating, what can you tell me about each of them? So let's take the first one, debt instruments. So what are debt instruments? No Googling, please. Nobody will Google, nobody will use your phone. This is a general knowledge test. You have to honestly sort of give me answers about this. Anyone? What is a debt instrument?
The issue, whatever we issue to have debt in our company, like liabilities, to create liabilities. Borrow some.
Say to create liabilities, then in that case, will you include capital also?
No.
Because capital is a liability.
No, capital will be from equity shares and preference shares, but debt instruments are debentures and bond side.
Okay, anyone else? Okay, you are right, Shruti, that whatever you're saying is correct. Somebody else try to express this differently. See, when you say debt instrument, what is the main word which is coming here? What is the main thing you are doing?
The loans.
Okay, so who takes loans?
The company takes loans from the public.
So what is that person called? A person who takes a loan?
Debt.
Not debt. Think of the word. Debt is
creditor?
the
Creditor?
the borrower. No, the creditor is the person who gives you the loan. The creditor is the person who gives you the loan. You are a debtor. You are also, in simple words, you are a borrower. So basically, a debt instrument is an instrument through which a company is borrowing money. Okay, so this is the first point here. Examples, as Shruti said, bonds and debentures. So the relationship between the holder of the instrument, suppose you buy a bond, you are the holder of that bond. So the relationship between the holder of the instrument and the company which issued the bond, is that of creditor and borrower. Okay. The company has borrowed, the bond holder has given credit to the company. So the bond holder is a creditor and the company has borrowed money from the bond holder, so it is a borrower. Everyone is clear about this? And two of the main instruments which are there are bonds and debentures. We'll try to see how these are different. Now, a debt instrument is issued for a specified period of time. Now, in the case of, let's say, a bank, you are a depositor. You go to a bank and you basically give the bank a fixed deposit. So even though it is a deposit, the bank is basically borrowing money from you. Correct? The bank is borrowing money from you. It is calling it a deposit, but basically the bank in that particular case is a borrower. And you have given money to the bank. And the fixed deposit normally always have a maturity period. 1 year, 2 years, 3 years. So the bonds also have a maturity period, but normally that maturity period is not very short. So it may be 5 years, 6 years, it may be 10 years, it may be 15 years. Government of India has bonds which are 30 years. So that is there. The only problem is that when you buy a bond which has a very long period of maturity, what is the risk? Think. Suppose a company issues a bond and is offering you a fairly good rate of interest also. But it is there for a very long time. It is there for 10, let's say 10 years or even 15 years. What is the main risk that you are actually incurring here?
So the future situations may not be.
Say again, Anamika, once again. Future situation
may not be favorable.
The future situation may not be favorable, or in a different way, you can say that maybe the company will not be so healthy in 15 years. In which case, remember that 15th year is very important. Why? Because you will get back your principal amount in the 15th year only. From the first year till the 15th year, you are only getting interest. But the actual amount which you invested in the company is only coming to you after it matures, after the bond matures. That means in the 15th year. So there is a risk here. Remember, if it's too long. Interest is paid after specified period. So normally the tradition in a bond is that you pay the interest after 6 months. Okay. Then, so let's say if the interest rate is 10%, so you can say that every 6 months, I will give you half of 10%, 5%. Principal sum is paid at the end of the period. This is something which you have to always remember. Now, let's go to the next point here. Suppose the company doesn't pay. What guarantee is there for a bondholder? How will he get back that money? Company doesn't pay. There is a problem. Like Anamika said, things might become less favorable, and the company may not be doing so well. So those 10 years are gone, and now the company isn't doing well. And now what will happen? What is the guarantee that these bondholders have that they will still manage to get their money back?
Sell their bonds in market.
But see, if the company is not doing well, Shruti, you will not find a buyer. It will be known to the market that this company is not doing well. So you will not have a chance to sell. Otherwise, what you're saying is correct. Suppose you anticipate this a few years before maturity, and then you try to sell in the market. Then maybe you will find someone who will buy it from you. But if you are coming to the end and you want to stay the 15 years, so this is the point which is not so well known about bonds. Let me come to this point. So the company has to secure the bonds by setting aside some of its property for the purpose. If the bond is not paid, then the company will have to sell the property and repay the bondholders from the proceeds of the sale. And as a measure of safety for the bondholders, this amount with this property which they set aside, maybe it is some land which they have, or maybe it is some building that they have. The right to sell that property is taken away from the company and it is given to a trustee. Now this trustee, see, a trustee is what? A trustee is a person who basically is responsible in a financial capacity for safeguarding the interest of the beneficiary of the trust. So who are the people who are benefited from the trust? The bondholders. Now to safeguard your interest, this trust is created and this property is put into that trust. Now if the company fails to pay, then in that case, what will happen? The trustee is going to take hold of that property, sell it, and he will use that to repay all the bondholders. So this is why a bond is absolutely secured. And that is the main, see, we all said that there is a risk. To reduce the risk, this security is given. In the world of finance, this is called collateral security. security which is available to you exclusively for that contingency where the company is unable to repay. If that happens, then that security can be sold and done. So this is in the case of bonds. Now, in the case of debentures, this facility is not there. See, debenture is also just like a bond. There will be a rate of interest. It will be paid in specified periods. Everything is there. But basically, in the case of a debenture, this facility is not there. It is not secure. So basically what happens out there is that you are doing in a debenture, the rate of interest will have to be a little higher. Because see, your risk is greater. In the case of a bond, the company will say that I'm offering you a not very high rate because we have secured your bond through our assets. So in case for any reason we fail, the trustee will be able to sell the assets and return your money to you. But in the case of a debenture, it is unsecured. This is the biggest problem here. So since it is unsecured, if the company for any reason doesn't do it, then what will happen? The money is gone. And over the last few years, there have been a number of cases in our stock markets where good companies have issued bonds and have not been able to repay. This has happened. And because of that, the bond market itself, there has been a bit of a panic. People are not willing to buy that easily because you feel that a bond is supposed to be secure and it's supposed to give you better rates. But if a company is unable to pay, then what happens? So this has actually happened in some cases. That is why I'm saying that no matter whether it is a debt instrument or an equity instrument, there is always a risk. There is always a risk. Okay. Now, so the risk is low as the instrument is secured by assets. Normally, the return will also be low. But here I have to make one point. The return may be low, but it depends on the credit rating of the company. So there are specialists in rating. Somebody like ICRA, CRISIL. So these companies, they actually are able to give a rating of the bond issue. Like let's say there is a company, let's take any company. Let's say that a company like, let's call it Shivaji Tires. The Shivaji Tires Public Limited is coming out with a bond issue. Now, nobody has heard of Shivaji Tires, or very few people have heard of it. And people want to, basically, Shivaji wants to borrow from the public by issuing bonds. Now, most people will not be willing to buy those bonds of Shivaji Tire for the simple reason that they have never heard of Shivaji Tire and they are not sure whether their money is going to be safe or not. So, these companies, what Shivaji Tire can do is, how can it increase the visibility of its bond? Or how can it make its bond a little more attractive and make people feel that there is less of risk? So Shivaji Tire management says that, look, we are a good company. We have been functioning for the last 10 years. We are listed in the markets. So even though we are not a major player in the tire space, we have been steadily making profit and we are doing well. And today we have an opportunity to expand. And this is why we want to borrow money. And this is why we want to go for a bond issue. Now, how does it make the public understand this? Nobody has the time to read. They may come out with a prospectus, a document in which they tell all about their history. Or maybe if you are really interested, you can go to their website and read. But you will always say that every company is going to speak good about itself. अपना तो तारीफ ही लोग करेंगे ना. तो उस हालत में, how do we get a objective opinion? Should I actually buy this or not? So what Shivaji Tire can do is, it can go to CRISIL And when it goes to CRISIL, it will go and say that, look, these are our financial statements. Please visit our company, see our actual performance. And once you have done this, then you give us a rating. Give us a rating. Because CRISIL has a certain brand value. And if CRISIL rates a company or an instrument, then public will say that this Shivaji Taj is coming out with a bond issue. This has been rated by CRISIL. It has a AA rating. That means it's okay. It's safe. So when they go there, and if CRISIL actually studies the entire company and finds that it's, the company is really pretty good, and it decides that I'm giving you a AA rating, what CRISIL is saying is that this bond, let us say, was a 5-year bond. Just for the sake of taking one period, let's say it was a 5-year bond. CRISIL is saying that this company is going to be okay for 5 years. And after 5 years, this company will be able to return this money to you. And during this period of 5 years, this company will be able to give you the interest that it is promising. How do we know this? We have actually gone to the company. We have looked at their finances in detail. And we have reached this conclusion that yes, they are okay. They can do this. Now we are giving a AA rating. So when this company actually goes to the public and tells them, look, I want to borrow money from you. We are a pretty good company. We have a AA rating from CRISIL. Now what happens is, it is able to offer a lower rate of interest. Slightly lower rate of interest, because it will now say that these companies which were also AA rated offered only 7%. Therefore, we will also offer 7%. Had the rating not been there, everybody would have thought that this company is actually quite risky that way. What would have happened? They would have had to offer a higher rate of interest to make you invest in their company. They would have, the risk premium would be higher. But when you get a rating from a rating agency like CRISIL, which has its own brand value, which the public recognizes, then you are able to use that rating to offer a lower rate of interest also. So you have two benefits. Number one, you are able to sell the bond to the public. Number two, you are able to sell it at a lower rate. And that's why I'm saying the risk is low. The risk is low because the company is rated. The risk is low because the bond is secured by assets. Therefore, the return will also be a little low. Okay. So these are the basic debt instruments that we have. Now let's take the next category, equity. Now, you may have heard of stock. You know the word stock. And then there is the word equity share also. We also call it a common equity share. So normally, when you want to understand the word stock, think of it like this. Maybe there are 1 million equity shares which have been issued. If I look at the entire bulk of 1 million equity shares, and I want to say in one word, I say stock of equity shares. It represents not one share, but the entire thing. That is the main way of understanding the word stock. Okay, now how many features of equity can you people tell me? Equity share. I have written down 5 or 6 points below this, but I'm leaving the screen blank. You people tell me. What is an equity share? What are its features? What are the risks, etc.?
High risk.
So the risk is that.
No, first of all, describe what the share itself is. Don't start with risk. Suppose you were to define this. What is an equity share? How will you define it?
So an equity share, it is the amount taken by a company on loan from the general public and giving the public some identity or some rights against that money.
Loan. गड़बड़ हो गया.
It forms the capital of
Okay, हाँ. Tell me, Shruti.
equity forms the capital of the company. The company takes money from the public as by giving them share, and it also gives them rights to vote in the company, and the risk is higher
Okay.
to other shares, and they can even get higher dividend when the company is earning more profit.
Okay. Some very good points there. Anybody else wants to try this?
Sir,
Because
it is a permanent source of income.
Of income. Who said that? Income? Monica.
Yes, sir. Yes.
Monica, see, you have to understand that income only comes when the company sells a product which it makes. This is a cash inflow, not because of income. It is because somebody is investing in your company. You understand that? You please understand the difference. Cash comes in. There can be two reasons for cash to come into a company. One is that the company sells a product. Let's say the company makes handbags. It sells handbags. The proceeds of the sales come into the company. That money is income. But when money can also come in when people buy shares of the company. And that is what is happening in equity. Okay, but good point you raised this so that everybody who was maybe had this confusion in mind, that is gone now. Anybody else? Anything about equity? Expressing it in your own language, something like that?
Sir.
Yes. Please.
Sir, yes, sir. Equity is amount funded by company, like owners and shareholder of a company.
Who is this? I can't see the thing. Who was speaking?
Adhirja.
See, think of it like this. Let's say that, so we use the word share. Now, what is share? Share is like a small, एक हिस्सा है किसी एक बड़ा सा चीज का. We are giving you one little share. Let's say that I start a company, 3 or 4 of us start a company, and there are 100 shares in this company, and we buy all the 100 shares. Now, tomorrow I want to sell these shares. So when I sell the share, what I am saying is that I am giving a small portion of my company to anybody who pays me money for it. So I am selling at the ownership of the company. Initially, let's say there were 4 owners. We started a private limited company. And then we said that we want to get the money from the public also. So we became a public company. We listed publicly. We started with a IPO, initial public offering. We asked people to buy equity shares. Every time somebody bought the equity share, what did we give these people? We made them owners of the company. But they are owners, they are not the managers of the company, remember. They are not part of management. They do not exercise control. But to the extent of the value of the share, they are an owner to that extent. If there are, let's say, 1 million shares in a company, and you buy 1 share, 1 equity share, that means you are owner of the company to the extent of 1 divided by 1 million. 1 million is the total. Out of that 1 million, you have 1 share. Now, but you are an owner. Please remember this. And this is the important thing to remember. Based on this, the other things become clear. Now, if you are the owner, the one thing which follows is you are only going to get some dividend here if the company does well. As an owner, you will not get anything if the company makes loss. That is the main difference between equity and the bondholder. That is why when you said loan, I reacted. See, the thing is that this is not a loan. You are giving just a little certificate that, look, you are owning this company to the extent of the number of shares you have bought. I have 1 million shares, you have bought 1 share, you have that much ownership of the company. Now, since you are an owner of the company, you will be getting a return on that, on your investment, only if the company makes a profit and declares dividend. See, the management may say that we have made a profit, but this year we are not going to declare dividend. They can do this. It is within their right. They are within their rights to do this. Why will they do this? They will say that, no, we are taking the entire thing to reserves. Why are we taking to reserves? We are going to invest that entire amount in buying new assets for the company because we want to expand. Then if the investor says that, what about my dividend? You tell the investor, you wait for 1 year, sir. And then you will see that you will get much a bigger dividend, which will make up for this loss of dividend this year. Okay. Now, so you cannot claim interest. Since this is not a loan, you cannot claim interest, nor can you have a fixed return. You are just entitled to dividend. When the company makes a profit and decides to give a dividend, remember, this is crucial. The management has to decide that we will give this dividend. Otherwise, you won't get anything. Then, in case the company becomes bankrupt, that means the company fails, the shareholder can lose all his money. It is possible that you will not get a single paisa back. This is not like the bondholder, where there was a body of assets which was there, which could be sold. And from the sale proceeds, the bondholder could be paid. This will not happen here. This is because the company goes into liquidation. What does liquidation means? Anyone? What is liquidation?
Sold out.
It has to sell all its assets.
Anyone? Yes, Shruti?
Selling of its assets.
Selling of the assets, converting the assets into cash, into liquid forms. Liquidity is cash. So liquidation is the process of selling the asset of the company and converting it into cash. Now, who will do this? Normally what happens is that the registrar of companies or SEBI, one of these people, not SEBI actually, the registrar of companies will appoint a person who is called a liquidator. And the liquidator will come and he will sell the assets of the company. Now, all of us know that when you try to sell something which is second hand, the machines are second hand, the furniture, all these things are second hand. Everything that they have, you get less money. And the factory building only has value for someone who wants to use it as a factory. Because mostly factory buildings cannot be used as residences, because there is a law against that. So the result is that when the assets are sold, if the value of the assets was 1 million, maybe it gets sold only for 300,000. So it was 10 lakhs. I'm only getting 3 lakhs. I'm only getting 30%. If I'm only getting 30%, then how will the equity shareholders get their money back? They will only get 1/3 of their investment, assuming that there is no debt in this company. They will only get 1/3 of the investment. So that is why it is possible. And suppose the assets are so bad that they cannot be sold. then in that case, take a case like Nirav Modi, where there were no assets to sell and the fellow ran away. So any shareholder in that company, they lost everything. Okay. Risk is very high. What you people said initially, the return can also be very high. Because remember, in the case of equity shares, there are two places where you can earn money. Anyone? There are two ways. One is the dividend. What is the other?
By
Share
sharing,
By
sharing our share to another person.
not sharing, selling.
Selling, sorry, sir, sorry.
By selling the share, because see, the price of the share, if the company is doing well, the price of the share will go up. So you will earn much more money through the capital gain, by selling it at a higher rate as compared with the dividend which you are getting. So the return can be very high. And that is why the stock market is so popular. Many of us like to keep trying and see whether we can make some money out of it. Okay. So the shareholder can sell his shares in the share market whenever he so desires. Shareholder has some rights also. So he has the right to vote on all issues that are brought up in the meeting of shareholders. So there is something called a AGM, an annual general meeting of all shareholders. If you are a shareholder of a company, even if you have just one share, you have a right to attend that AGM. And at that AGM, if some motion is, some resolution is there and people have to vote, you have a right to vote. Value of your vote is in direct proportion to the value of your shares. Okay.
So a company has so many shareholders. So will it, allow all the shareholders to take part in the AGM?
Theoretically, yes. But in practice, what happens is that most of us who buy shares in companies are not interested in actually trying to take an interest in the management of the company. We are not interested in that. Our interest is, if the stock market shows that the prices of the shares are good, we go and sell it. So I would say that 99% of people who buy shares are those people who actually just want to make some quick money out of it. Or maybe there are some people who want to earn dividend. They are not so interested in actually taking an active interest in the way the company is actually run. That they are not interested in. So they will not attend the AGM. But there are some people who like to attend AGMs because either one, they have a large number of shares. So for them, it makes a difference. And they want to take an interest in the policy decision. Or there are some people who are there at the shareholders meeting only to create trouble. This is a fact. When I was in the bank, we would have these shareholder meetings. And every year there would be some people who would come specifically for the purpose of either eating the snacks or asking inconvenient questions and watching the high officials having difficulty in answering. For them, that was the main purpose but they had that power. See, the point is, they had that power as a shareholder. Nobody could say that you have only 100 shares, keep quiet. You can't say that. Person has a right. If he has come to the meeting, he has the right to say these things. The other thing is, you hear of all these posts within the company. The chief financial officer, the chief marketing officer, chief executive officer, and so many other posts. To enjoy an official post, you have to be a shareholder. That's the other thing. So a shareholder has the right to have an official position in the company. Now, here, one point which I had raised out here. Suppose the company goes bankrupt. And it goes, a liquidator is called, the liquidator begins to sell the assets. And let's say that he is able to sell the assets at 50% of the value. So let's say the company was worth 1 million, 10 lakhs, he is able to sell for 5 lakhs. Now, who has the first right to get back the money?
Debenture holders. The outsiders first.
Okay, outsiders are first. People who, basically the creditors, use this word. The creditors, the persons who had given you money, who you had borrowed from, they have the first right. After all the creditors have been paid, only then is a right there for the equity person. Only then can the equity holder get something. If anything is left, remember, it is not in proportion. If it is sold for 5 lakhs and the entire 5 lakhs goes to pay the equity, the debt holders, the creditors, then you're gone. You'll get 0. If, let's say, 4 lakhs goes to pay the creditors and 1 lakh is left, then all the shareholders will get a proportion of 1 lakh. This is the risk in equity. That your position at the time of liquidation is last. Okay. Now there is one category of share where the position is a little better than last. This is the preference share. In a preference share, what happens? Anyone? Anybody can tell me? Go ahead.
So they get a preference in the payment of dividend over the equity shareholders.
They get a preference in getting dividend. Okay, then Shruti?
Even in the condition of winding up of the company, the preference share has the more preference than the equity shareholders.
Okay, that is absolutely correct. Anyone else? Okay, let's look at this way. So first of all, they are similar to equity shares, but these preference shares have some features that make it closer to debt. Remember, in debt, we said that the company has borrowed something. When the company borrows money, it pays interest. This is the basic thing in borrowing. So in some respects, this preference share is close to borrowing, to a debt instrument. In other respects, it is close to equity. So let's try to understand this. So if I'm trying to calculate the equity capital of a company, remember, for the purpose of balance sheet, you have capital, borrowings as the sources of capital, or sources of funds. Can you please mute yourself, whoever is speaking? Okay. Now, when I'm trying to calculate how much funds a company has, how much capital it has, I will add preference shares also. So to that extent, it is considered to be equity, 1. Now, which are the features which make it close to debt, close to, let's say, a bondholder? For example, normally, depending on the contract, see, there are separate contracts for different preference shares, but depending on the contract which the company is giving, he is generally entitled to a fixed dividend if the company makes a profit. So he's supposed to get a fixed dividend. You fix it before. We'll give you 20%, we'll give you 15%. Every year you are going to get that. Even here, there are 2 possibilities. Suppose the company makes a loss in 2020 and the fellow is not paid. 2021, the company makes a profit. Can he demand that you give me that money which you did not give me in 2020? I was entitled to 15%, you didn't give me. Give me now. Anyone?
In the case of accumulated preference share, the shareholder can demand that.
Not accumulated, cumulative. Don't say accumulative. Cumulative. So cumulative means which is added on. So let's say that in 2019, this fellow invested. 2020, the company did not declare dividend because it was in loss. Company didn't pay. In 2021, the company makes a profit. The company will have to pay 15% for 2020 also and for 2021 also. That is the meaning of cumulative. So the contract between the preference shareholder and the company is like that. So this happens. Okay. Now, if the company goes into liquidation, the point which Shruti was making, then the preference shareholder has a claim to get his investment back after the debt instrument holders are paid. First preference will always be the creditor. First preference, remember, is always the bondholder. Bondholder is paid. If there is a banker in the mix, the bank will be paid. After these people, the preference shareholder will come. And after the preference shareholder, right at the end of the line, that will be the equity holder who is hoping to get something. Okay. So this basically brings me to the end of the things which I wanted to teach you in this course. So what we have done is I've tried to give you a broad overview of some of the basic fundamental things in finance, the fundamental concepts in finance. And I have also tried to show you some basic financial accounting. We had a look at entrepreneurship and the lean canvas. And then I think we had this discussion on compounding and discounting and the time value of money, NPV, IRR. So most of cost of capital, weighted average cost of funds. So all these things that we have done, broadly speaking, this is giving you an overview of what happens in finance. When you study finance in more detail, basically it is these things which you do in more detail. There will be other things also, but these are the main ideas in finance which are there. For example, one area which I could not touch because it is very mathematical is valuation. How do we value a company? How do we value a stock? The whole concept of value, that is something which is entirely based on maths. So it becomes difficult, even though you can use Excel. But even in valuation, one of the things that is done, you have learned, and that is discounting. Because valuation is also worried about present value. So since you now understand what present value is, you understand future value, you always understood. Present value, you now understand. You understand the concept of time value of money. Because of this, maybe tomorrow, if you really decide to go more into finance, some of the other things in finance which are taught, those things are going to be helpful for you. Also, it is going to help you to understand basic concepts a little better. That is what I am hoping. If you can do that, it's really going to be helpful for you. So now I'd like you people to ask any questions that you have about any aspect of the course, or at least tell me what are the things which probably you gained from this. What are the things where you need to work more? Where are the places I need to work more to make it clearer to you? So if you can give me some feedback, that would be very helpful. Anyone? See, one thing I'll expect is that at the end of the day, those Excel exercises that we did, use them. Don't let it just, be, you understood it today. Try to use them. All those of you who have created an Excel file today, save it properly. Save it properly in your computer and try to do some exercises. Like if you just change the discount rate, see what happens. Try to use those compounding formulas which we learned. That will, even if you are not very, comfortable with numbers, doing it in Excel will really, it'll, what shall I say? It'll empower you. You'll feel good. These are very complicated things which I can actually calculate on my own. So try to use that properly and it will help. And tomorrow, if, for example, the costing part, where we began with that whole concept of companies being price takers. and the concepts of direct cost and indirect cost and all that, and variable cost. So have a look at those slides. So I've sent the complete thing. Today's presentation, those of you who are keeping a copy of this presentation, please keep today's copy. The one I sent today. All the other ones you delete, because there were small mistakes in many of them, which I have corrected. So the one which you have today, that is complete. Use that. And of course, through Neeraj ji, if at any point of time you feel that I can help somewhere, let me know. So that, we can continue this discussion, because at a general level, those of you who are from, let's say, disciplines other than finance, I think you people should all take some interest. The finance is there, very much part of your life. Whether you like it or you don't, you cannot actually avoid finance. It is there. Because ultimately it is going to affect your own financial health, the way you plan things. And later on, of course, when we start the full-time course for some of you on finance, we will also look more closely at financial planning. So I've decided that instead of sticking only to these core concepts, we'll also look in detail at financial planning and where you invest, what are the advantages, disadvantages, what instruments, what are the returns that they offer, how can you understand these things better. We'll try to do all that a little more. And these things which we have done now in a very, very general way, and try to keep numbers out of it completely, except for yesterday and today. Even today was hardly numbers. You are all using Excel, so I think that would have made it a little easier for all of you. See, when I spoke to you about Excel, one of the things which I was hoping is that you will understand that very complicated things, can become very easy because of simple formulas which are there in Excel. All that is required is that you, if there is a mental block at using figures, you overcome that block. And the best way to overcome it is do a few exercises, you'll be fine. Okay. So any questions from anyone? Any words you'd like to say, since this is the last of this particular sessions that we're having? I can say that I've thoroughly enjoyed interacting with all of you these last 2 weeks. It's been very nice. And I hope that I've been able to give you some exposure to basic financial concepts.
We have also enjoyed, sir. The way you explain, basic concepts are clear now. The content of this course is really good.
Thank you so much, Paresh. Thank you so much. And I can tell you one thing, that the content of this course has been made possible because of you people also. Some things which I included here, I did after we began. For example, that section on entrepreneurship, which we had the lean canvas and all that, that was something which I did later. I had once taught a course on entrepreneurship. So it was easy for me to get that and make it part of this course. But later on, I realized that may have actually been helpful to you to understand, how a business starts and how it generates ideas and things like that. That is also a very interesting area, entrepreneurship and understanding.
Yeah, very interesting.
It's very interesting. And those of you who, like Paresh ji is, let's say, older than you, so he will probably appreciate this a little more. But those of you who may consider, starting your own business at some point of time, you'll find that lean canvas now is a very good place to start. A very good place to start, because it is like, holding a mirror to your proposal. And you will see just how good it is or how bad it is. And it will help you a lot to save, the time and trouble and money and investment on a bad project. Just like IRR and NPV and all also help. But that is the next stage. The first stage is do the lean canvas, try to understand and do it honestly. Second, once you have some data, tried to do that NPV calculation. And what we learned is if the NPV is positive, then maybe it makes some sense to make an investment. If it is not positive, don't touch an investment like that. And so that NPV, IRR, those are very fundamental things in taking financial decisions about investment. So hopefully, if you have understood even a bit of it, it will help you. Okay, then if there are no other questions, we can end here. Thank you so much, everyone, and good night.
Thank you, sir.
So much, sir. Good
Thank you.
night.
Thank you, sir. Thank you so much.